Hi, everybody. I'm Jeff Barton, your voice in the mortgage industry, and this is the Mortgage Minute. We're on LinkedIn and Facebook every day. You can hear the radio show, which is an hour long on the weekends, 5 radio stations in 3 different states, from Albuquerque to Las Vegas, in the Inland Empire, a couple of stations out there, and also up in Tahoe. We're trying to expand what we do, but it's difficult, needless to say. Anyway, let's get right to it, okay? The rates today, 2.8%. For the 30-year fixed, 2.38%. For the 15-year, 2.35 for FHA. Now, FHA, as everybody knows, comes with it a fee on a monthly as well as an upfront fee. So that APR is not necessarily 2.35, but it's below 3, and that's pretty good. 3.17 for the jumbo. The jumbo is really priced terrifically today. The 5/1 arm at 2.52. All of these limits and all of these rates, rather, are subject to you, the borrower, and whether your credit score is great or whether how much money you have in the deal, whether it's a cash out refi, whether it's rate and term. All of that is subject to what these rates are. So if you want the best, take out the least, have great credit, and make sure you have an ability to repay. All those things will be able to get you the rate and term that you're looking for if you're looking to save money on the monthly. If you've got 5 years or so into the deal, you want to calculate that out. To make sure that it makes sense for you to do that, especially if you've got for instance, quick story. When we were doing our rate and term on my house, which we paid off several years ago, but at the time, the 5.125 rate was a great rate. We took it. Subsequent years, obviously, everybody knows the rates went down. So as the rates went down, we had to calculate whether it was a good deal for us to remain in the 5.125 loan on a 15-year or whether we were to, refi it into something where the monthly would be less. We decided to stay with the 5.125, and after 15 years, we paid off. Now, had we done the refinance, we could have saved some money, but we would have lost all the interest we had already paid into the loan. So our calculation was no, it wasn't a good idea for us. Let's see, guy named Charlie Scharf, who is Wells Fargo CEO, and all of these big box banks, whether Bank of America, Wells Fargo, Chase, they all have their reason for what they do, especially when they do loans. Now, you can go to all those particular companies and get loans. If you are a preferred client, if you are a wealth management client, you can get a terrific loan. If you are a cookie cutter, paper loan, cash out refi, or rate and term refi, you're going to get a great rate because you're already their customer. They want to keep the customer. And if you already have your loan with them and they're servicing it, yeah, they want to keep the loan too. However, most people don't fall into those categories. And one of the things that I wanted to talk about quickly today was, and we talked about it the other day on the show, is it a good idea for some of the large mortgage lenders to go public? Now, what do I mean by that? Well, the big box banks, Chase, Wells, Bank of America, they are hemmed in by shareholder and shareholder equity, shareholder value to the stock is impacted. It was impacted in 2008, which is why a lot of these companies got out of the aggregate business of buying loans from other people. They don't do it. And usually what happens is they do internal loans only, and it has to be perfect, makes sense in order for them to have securitization on those particular stock mortgage-backed securities that they end up selling. When you have United Wholesale as well as Quicken, which is now Rocket Pro, right? Rocket Pro TPO. It's a joke. Anyway, and when you have that, what's going to happen when times get tougher? Are we going to see those particular mortgage lenders expand their portfolio of loans, or are they going to shrink their portfolio of loans, i.e. by higher lending standards, because now they have shareholders that they have to be beholden to? I think the latter, and I don't think that's a good thing for the mortgage market. However, there is opportunity for other mortgage lenders. Problem is that a lot of the smaller mortgage lenders sell their loans to Rocket TPO, Rocket Pro TPO, and also to United Wholesale. So in that is not the best for you, the consumer. If you're listening to this, you want to try to probably find somebody who doesn't sell to them, who sells to private equity or private GSEs, non-Fannie, non-Freddie, especially when you're in, I mean, if you're going to go to the length to try to get a loan from somebody who is not of the ilk where they have a public um, ownership of the company through stock, you're probably going to want to go to a non-QM lender. Now, non-QM lending services things like bank statement loans, 1 and 2 year W-2s, self-employed borrowers, things that are not necessarily sold to the GSEs, right? No, they're definitely not sold to the GSEs. And certainly Super Jumbo is in that. There's a lot of different programs. I'm going to get into it on our radio show on the weekend if you wanted to listen to it. We're going to talk to a guy over at Lima Capital. Let me get his name here, Rob Parsley, and also Paul Vincent from Accelerate. Both of those do conventional, but they are in non-QM space as well. And I think that's where you need to end up being if you want to, get the best deal possible for those non-traditional loans. And as the market gets tighter, year down the line, year and a half down the line, those particular lenders who have gone public are not going to have the same flexibility that you're going to find in a non-QM lender who sells to the private market. I'm Jeff Barton, your voice in the mortgage industry. Sorry, we went long a little bit. Bye.